I'm happy to bring back Chris Whalen, chairman of Whalen Global Advisers, my personal friend, very good friend, and advisor to a lot of top Wall Street firms. Chris, welcome back to the show.
Hey, my pleasure, Alex. Happy Thanksgiving.
Happy Thanksgiving to you too. I have so many topics, but I wanted to focus just on a few. I know you're short of time. I just watched you on Bloomberg News, phenomenal piece on Julia's show. So, you are all over the place. Got your book Inflated, phenomenal read. I would definitely
Thank you.
recommend for people to get it. And obviously follow the institutionalriskanalyst.com, which is Chris's blog. Every morning or every day, Chris posts something. Great read if you're a trader. If you're trading in mortgages, certainly this is a must read for every investor. All right. So I want to start with AI. It's my
Mm.
passion. I think it's your passion too, or it's becoming
Oh,
your
yeah.
passion. All right. So Nvidia reported Q3. They exceeded expectations. Few days later, they're down 3%. Nobody knows why. We got Meta reporting. We got a few other hyper scalers, they call it, right? Reporting, and people didn't appreciate the fact that Meta is getting a loan. Meta is depreciating a very fishy way, I guess. So to me, we have to answer a couple of questions. Is AI a bubble? And is there a investment that is a good investment in AI, and how would you position your portfolios or your stocks by investing in AI?
Well, I think by definition, Alex, AI is a bubble because Wall Street has taken it and blown it up dramatically. All of the public companies who have any potential application for enhanced intelligence tools, right, have been forced to spend vast amounts of money. You look at Oracle. The spend there may end up, tipping over the company because the numbers are so big. And likewise, all of them, Google, Meta, all the rest, they've had to chase large language models. And you and I both know that that's not going to lead us to where we need to be. So that's the first point. Second, the spend is mostly on infrastructure. Jan LeCun, the former head of AI from Meta, lays this out beautifully in his interviews online. I recommend that your viewers watch it. He's a very smart man. Years ago, as a banker, I covered what was then called natural language processing. This was a bunch of smart people from UCLA who were trying to teach computers what words meant. So much more interesting than what we're talking about today. They were actually engaged in a semantic exercise where you started with a taxonomy of words and you loaded them into the computer and you tried to teach the computer how to understand the words in context. That's much more impressive than what we're talking about today with ChatGPT and everything else, right? So you wind the clock forward, we have more processing power. And as you pointed out to me the other day, we summarize, the search results on the first page of Google, but the answers are often wrong. So while this is neat for consumers, I now don't have to retype interviews. I have transcripts. Or lenders, when they speak to a customer online, they don't have to, do anything. They just push a button. A transcript is generated of the call. They review it. And they say, yeah, that's correct. And they put it into the file. So those are wonderful applications. But is it going to generate revenue commensurate with the spend? No, definitely not. So I think it is a bubble, and it's a bubble that's going to be very costly for these public companies to resolve. And you're in the thick of it because you work with companies that need more intelligence and file review and due diligence and all the rest of it. And we're not quite there yet. So, you know.
Well, they need, but they resist, right? So it's a human element as well. I don't want to adopt AI just because it's my job. People that need to educate AI and what to do, and we probably need to define what AI is. They are level managements that know that if AI is taught what they know, companies don't need them, right? So you'll see, right? So there's a lot of human elements involved in my mind, and when we deploy the models, it's exactly what happened, right? So there's the human element that is resisting the deployment of AI. Now, what I wanted to kind of recap, I don't know if you followed the outage detector. So on Monday this week, when we're recording, Cloudflare was down for about half a day because of the spike of traffic. All the web-based applications, well, half of them were down. ChatGPT, X, etc.
Oh, yeah.
Prior to that, IBM Cloud. Prior to that, AWS. Prior to that, Microsoft. Well, it's not Microsoft False, but yeah. So if I would tie the dots, it would imply to me that we have no infrastructure to support the need for compute power that AI will give us. So investment in um, architecture of AI or infrastructure of AI, data centers or chips or this or that makes sense. Applications on AI, freeware. Is that how you see it, or sort of you have a different spin on where to invest?
I think you always need more infrastructure, Alex. That's a given. And I think you've hit it on the head. The cloud-based systems at times fail, and they fail a lot. So, okay, fine. More systems is great. Will we ever get rid of that tendency for the networks to have latency that causes, X not to work for 20 minutes? No, it's just it's part of the industry. It's part of the technology. I always laughed because in the early days, I've been involved in computers since before computers. Somebody would always kick the plug out of the wall. And it might take half a day for people to realize that that plug was no longer plugged in. Things didn't work. In my old firm, Institutional Risk Analytics, we actually had our own server room, this massive room of IBM clone servers, 4-drive Pentium machines, right? And we would have to restart them on the hour to get rid of the errors generated by SQL. That's how messy SQL is, right? So here we are today. Architecture hasn't changed so much. Technology, has it really changed? No, we just have more horsepower, but it's all in the cloud. So we now have a telecom issue as well as just the machines themselves. And I think that explains a lot of what you were just describing.
Yeah, plus AI, if you really think that AI will at some point have a real conversation, real-time conversation, you need real-time response. And for that, you need, a very high connection to whatever the point of contact with AI is, data centers, processing power, chips. So all of that, it'll take some time, years probably, right? With all the permits that you need for the data centers, it's probably much easier in China, much easier in
Well,
China.
I think the joke is on the Chinese because they have thrown so much resources into this whole large language model bunny hunt.
Yeah.
That's not, as Jan LeCun said, what we need is machines that can see the world around them and react to those inputs. That's a long way off. We will all be dead and gone before we even get anywhere close to that. So the question is, what is the utility of this spend? And can companies start to slowly make um, applications that are reliable enough and relevant enough so that people will pay for them? And of course, LeCun reminded all of us of IBM Watson. You remember Watson?
Sure.
You were a very young man when we were watching the Watson ads on television. It cost IBM a fortune. But as we all know, for those of us who worked in the tech sector, never confuse sales with execution. That's what Big Blue taught us. And this is all about sales. This is all about stock prices. I've been in and out of Nvidia several times. I'm very grateful to Jim Cramer, but the reality is that I think they are going to see a drop in demand for their technology simply because everyone's exhausted. The amount of money that's been raised publicly and privately, ChatGPT and AI, how many flavors of AI funds do we have now?
Over 50,000 a year, new startups. Crazy. It's crazy.
And most of them will lose money.
Yeah. Yeah, I agree. In fact, I talk to my clients, and this is a big hurdle for me as a AI technology provider, even though it's connected to the mortgage industry, is all the executives that I talk to, they say we have a pitch of one AI startup or one AI company every day over LinkedIn or email, and they're pitching all kinds of different AI freeware, right? And I'm concerned that there's no money in it, right? It's
Yeah.
cool, proof of concept is cool, but to get it down to the actual application and execution, that's where everything falls apart.
And to get it down to that last, and that last mile that allows you to have the confidence to roll the tool out and know you won't be sued. AI
Yeah.
looks to me like a gift to the trial lawyers. And, Alex, you and I both work in a consumer-facing business. You have to be cognizant of the fact that every consumer has a different problem, different issue. Every loan is different. So in order for the technology to be able to address that, you almost have to have a human being standing behind it, monitoring it and watching it and say, whoop, I got to get on this call because the machine just missed what the consumer tried to say. So.
But I do understand why people are investing in AI in our space, mortgage and MSR
Look,
space.
there are applications that are
Well,
great. You and I see it. It's okay. It's just we shouldn't expect too much from it. And it's an expense more than a revenue opportunity, I think.
initially, yeah, but at the same time, I feel that I'm hearing from some of my clients that the largest part in the origination process spend is the sales and marketing. Anywhere from $5,000 to $9,000 have been spent on brokers, LOs, upfront sales, marketing techniques, and that's where they try to deploy the agents, the bots, to call automatically and convert. They don't care about the conversion rate as long as this freeware converts something, right? So for them, it's an instant conversion and benefit. So that's where I see a lot of the money flow into.
Well, there you
It,
go.
yeah.
But
So
think
that
about how long it took the industry to adopt Salesforce. And think
yeah.
about how many lenders are still out there not using tools like that. Even though you can customize the platform, it's white label now. You can make your own. But LOs look at that and go, oh, you're trying to put me out of business, right? You're trying to get rid of me. Well, maybe.
Yeah, and in fact, that could be an interesting investment from the AI bubble perspective is Salesforce, right? So Salesforce would benefit from everything related to AI because more leads will come through the platform. It's you need a better CRM, conversion, etc., calls. So maybe as a byproduct of AI investment, Salesforce would benefit.
Yep.
So on the AI side, let's see. Everything is everything that was said. I agree. Now, um, we can talk about Michael Burry. We can talk about his short, right? I think he's out of that. So he's the one that caused this AI bubble conversation in my mind. Um,
Was he the
do you think?
first?
I
What
don't
was he
know. I mean,
shorting? Shorting
he
Nvidia?
was he was shorting Nvidia and Palantir, right?
Yes. Tough to get.
And
Palantir. Very tough. See, in this market, when you have not passive strategies, that's a misnomer, but ETFs are hard to short because you and I buy ETF shares, they buy more. So
yeah,
the bias is up. And then, as we've just seen with Bitcoin, when you have selling, the bias is down. It's like the doomsday machine. And it just drives prices, especially of illiquid assets, down even faster than the pricing would indicate. So it's a double-edged sword.
let me jump on that. Why Bitcoin is not correlated to gold? Today, Bitcoin is down to $85,000. Gold is
Yeah.
still, above four. I would think that they would correlate.
Well, not anymore. In the early days, perhaps, but once Wall Street discovered it, as we wrote in the blog, it became correlated to the financial markets both ways. So I
Mm,
think, unfortunately, you've seen some of the Bitcoin promoters have migrated to stable coins for this reason. You've even seen people like Figure, that housing IPO earlier this year, right? I was in and out of that stock. I did a nice turn. They actually went to the SEC and got their stable coin blessed because it has an explicit yield. Anything with a yield is a security.
yes.
So to me, the whole stablecoin model is kind of crazy. It looks like a prepaid gift card. But if you're talking about Amazon or Walmart or somebody who has a reason to get consumers to come into their network and buy stuff, you give it to them at a discount, the Amazon
Mm,
coin or whatever. Um, but I think just as a standalone, you can see what's happened to Circle. The stock has gotten killed because the business case is not there. They have to give away a lot of their revenue to partners in order to make it work. I'm going to give them my dollars. They're not going to give me the yield on the dollars, right? And I have to pay them fees to play with their toy. Like, say I want to set up a stable coin for my company, which again is marketing. That's a valid use case, right?
Yeah,
But it's expensive. I might as well just give people a discount.
true. But now, is company like Figure or Raven Financial or similar companies or Redwood for that matter, are they the biggest threats to the traditional banking?
No, I don't think so. Yeah, I don't see the stable coins as a threat because I buy the coin under the Genius Act. You have to deposit the funds or invest them in high quality liquid assets, which must be safe kept by a depository.
Right.
So is it hurting the bank? No. I think net for the U.S. Treasury, somebody buys, somebody sells, right? I think that's a wash.
Yeah.
Um, it's just, to me, another marketing tool, on the part of a big crowd of people who have nothing better to do, Alex. So they saw crypto, and then, you know what I'm talking about, and then
Yeah.
they saw the stable coins as a way to do a little razzmatazz in marketing. But at the end of the day, is this going to be a long-term thing? I don't think so. The banking industry is going to kill it. The bankers, as you know, move very slowly. But right now in Washington, there's a battle, an epic battle going on. It's like the Lord of the Rings between the crypto guys and the banks. And the banks have said, nah, no more. You want to have your coin with a yield that's a security, but you can't come into our house, right? Um, the Trump people initially, I think, pretended to be more supportive of coins.
Right.
But now, the midterms are coming up. I'm not sure they care as much as they did last year. So, the oomph coming from the regulatory agencies is less and less effective in terms of boosting the prices of these things. So,
But at the same time, Trump did allow the crypto asset to be used as the asset for the mortgage approval, right? So that's a step in the right direction.
well, they said they would, but do you know any lenders who are doing that?
One.
Right. I have seen a couple in the jumbo space. I have not seen anybody who is selling mortgages into the government or agency market because the risk is just too high. You have Bill Pulte now, but who are you going to have at FHFA 3 years from now or 4 years from now? And the rules will change. And this is why a lot of our clients in the lending space, Alex, they prefer the government market because the rules don't change. The rules with Fannie and Freddie can change depending on what day it is. I've been going through the torments of hell with one of the GSEs lately because they're like the post office. You know, all of the people who understood finance are gone. They've retired. They've had enough, and what's left is
Not just them. FHFA is a mess as well, right? So
yeah.
it's
But at least we had
weird.
a good team at the top. You know,
Yeah.
oh my God, night and day. Can you imagine? Compare Alana McCargo with Joe Gormley at Ginnie Mae? Come on. Joe knows what he's doing. So that, to me, is wonderful. We haven't had to worry about that. There are issues that are, being dealt with there, but they're being dealt with by people who understand mortgage finance, which to me is a good thing.
Huge positive. Real quick, I wanted to switch to hedging and MSRs.
Mm.
Um, when I speak with my counterparts, vendors, or mortgage companies, smaller mortgage companies that don't play in that market, they do not understand the mechanics behind hedging. So let's start with just explaining that on the theoretical terms, the mechanics of why you need to hedge using MSRs.
It's mostly about appearances. If you're a public company and you take a write down on your MSR because interest rates are falling, a lot of investors who buy your stock or own your debt are not going to understand that that's a non-cash charge and that even though the fair value, which is modeled, has fallen, you're busy making new ones. This is the argument of Matt Ishba at United Wholesale Mortgage. He's like, well, the MSR may go down in value, may go up in value. Don't give me credit for that either way. And he's right. He says, I'm going to go out and make more. And the question is, ultimately, what is your cost of manufacture for the asset? That's what matters. So I think for private lenders, I've written about Stan Middleman at Freedom. He would prefer to save his money use that cash to go out and make more loans rather than worrying about trying to hedge the potential change in the fair value by buying or selling, swaps and or TBAs in the forward market. Now, you have to hedge your pipeline for your loans. You're short. You have to go out and make sure that you balance it off so you don't take too much risk between the time you close the mortgage and the time you sell it into a pool or you assign it, right? That's different. But when we're talking about MSRs, ultimately, if I'm a community bank and I have a big loan portfolio, I shouldn't hedge at all because the loans are positive duration. The MSR is negative duration. It's a perfect natural hedge. And by the way, if I don't sell the MSRs, they're not even on my balance sheet. I don't capitalize them. They're just there. It's like Europe, right? They don't like intangible assets in Europe. So that to me is the issue. How much do I spend my cash to hedge this intangible negative duration asset for non-cash changes in the fair value? Because remember, even though the MSR prepays, I have the right to talk to that customer.
Yeah.
And that optionality, that permission I have to engage with that individual and maybe refinance the mortgage that just prepaid, that's a beautiful thing. That's the primary asset of the MSR, aside from the cash
Recapture,
flow.
right?
Yeah.
It's a
Or
recapture of the
See,
future business.
in the industry today, Alex, we're creating little walled cities. It's like medieval Europe, right? And there's a little moat. And inside the city are the citizens, and those are our assets. And we try and keep them in our network. So whether you're JP Morgan or Rocket or PennyMac or any of these big shops, all of them have the same strategy, which it's mostly focused on the servicing. They sell the mortgage note to an investor. It's more effective to do that, right? But what they really want to do is capitalize that servicing as inexpensively as they can and make sure that their cost of manufacture is as low as possible. That's the key. So you look at Stan Middleman, say, versus United Wholesale. I would say United Wholesale's cost is higher because he's pushing volume. He's out there. He wants to dominate the broker channel.
Sure.
Okay. On the other hand, you look at shops that are really good at lending. Stan is very much dominant in the government market and the VA market. He can make MSRs very inexpensively, and that's his advantage. He's very good at recapture. He's very good at refi.
So that's interesting. So it's a pool of citizens, assets as you call them,
That's right.
and
We are
thinking
assets, me and you.
we're assets. That's right. It's funny that we're pawns in the game of chess. So they're fighting for a smaller, diminishing pool because of their affordability, right? So it's less people can afford the mortgage, less people can qualify for the mortgage. So MSR becomes a recapture tool, not necessarily the risk tool. But at the same time, if you look at the PennyMac earnings, didn't they announce that because of the MSR hedging, they received $100 million boost to their earnings? And even though they spend more and their earnings didn't look good, I think the MSR hedging helped them to improve their earnings. Or
Yes.
maybe I'm okay.
Well,
So
that's the trick, though, to get that right and not spend too much on that hedge is key because there have been quarters when PennyMac spent too much, or at least it was perceived to be too much, and their investors said, "Well, your GAAP earnings have gone to hell." Now, you and I both know that GAAP earnings are not relevant to mortgage companies. It takes you a few minutes to really stare at their income statement and come to an understanding of what's important. What's important is probably EBITDA, cash
yep.
flow, right? So if you understand that, and you also understand how the amortization of things like MSRs impacts GAAP earnings, then you start to come to a better understanding of, oh, okay, cash earnings are here, GAAP earnings are there. Which one do I focus on if I'm thinking about buying or selling a stock or buying or selling the debt that's issued by these companies? The best examples to me are the ones who've been able to finance their servicing assets in the bond market or reasonably with bank finance and leave their equity capital free to use as working capital behind the lending business. Because let's figure, if you look at most of these companies, they have a big chunk of their money tied up in loans. You
Yeah.
can see the warehouse finance for the loans. So you take that off. You just immediately take that off the table. Then you look at what's left. You compare the MSR with the corporate debt, and that's how you figure out if there's any value there.
Interesting. All right. Hopefully, folks learn from what Chris said and pick the winners and
Well, we got to go
losers.
find a university. We'll have like mortgage class. I can get,
Mortgage University. Yeah.
well, why not? We could get some of the players like David Spector. I would love to have him get up for an hour and talk about this because he's a smart guy. He understands, you know?
We'll bring ex-government folks to teach about how government works and how it impacts the lending.
How it
That
doesn't
will be
work.
fun. How it doesn't work. That's right. Chris, so final thoughts for my audience on what you see in December of 2025 and Q1 of 2026. I do see, still I do see some cockroaches coming out.
Mm.
I do see some cockroaches in the private credit. I do see from my companies and business of my companies that there's some collapses, and we're not done cleaning the pest control yet, right? So, they're still there, and we didn't hear the last of it. That's why I'm a little bit of concern with the market moving forward. But maybe you see a different view of what's going to happen in end of the year and moving forward.
I'm not bearish on the mortgage industry per se because I think the more efficient firms are going to do very well next year.
Sure.
Rates are going to eventually fall. You will see higher volumes. Hopefully, we'll close that spread, which has been, very stubborn. You've had treasury yields falling and mortgage rates going up. So by definition, that spread's been widening. Part of that is the fact that the Fed is a net seller. They're letting their book run off.
Yep.
So that is a problem. But overall, I think the big issue still for the industry is downsizing capacity back to kind of where it was before COVID. Because, mortgage people are entrepreneurs. They don't want to get out. The last thing they want to do is get out. They want to build a business, make money, and employ a lot of their friends and colleagues and go out and make loans. So to me, that's one of the great attractions of this business. I think the real issue for next year is not mortgages. They're going to be fine. It's the rest of non-bank finance that's going to be a bit of a problem.
Private
So
credit.
as you said, oh God,
Yeah.
private credit is going to continue to spew these idiosyncratic events that people at first are not going to understand. They're going to say, how did that happen? And I think it was just part and parcel of this idea that private equity investing was somehow better than investing in public markets. Mortgage people invest in liquid assets that are easily financed. Jumbos are a little different. They can come and go depending on how the banks feel. But ultimately, the bread and butter of this industry are effectively T-bills. Once that loan is endorsed, you can finance it in the repo market for 30 days right over the curve. I work with my friends at Cohen and Company. We're probably the biggest gestation shop in the industry. We run about $4 billion in repos. That's a very efficient way to deal with the asset. It self-liquidates. If everybody dies, we just deliver the mortgages into a
Yeah.
TPA that we use to price the transaction. So it's kind of cool. I think it's the other parts of the world of non-bank finance that are going to be causing a lot of problems. Insurance companies that have been buying subprime debt and all of this private credit crap. You saw the insolvency of PHL up in Connecticut. You're going to hear a lot more about that. I just did a piece about the non-bank issuers that we follow, Ares, Apollo, Brookfield. Well, guess what? They all bought insurance companies, right? They all followed Warren Buffett because they said, oh, well, it's book value. Yeah. So the stuff they've been putting into these insurance companies, frankly, is toxic. And that's going to dominate the narrative next year. Banks are okay. They have some exposure to this. But the consumer side of banking is still boring. In fact, deposit growth is down, and the banks don't have any loan demand. Banks have been shedding their borrowings from the home loan banks, for example, for over a year. They don't need the financing.
That's
So the
right.
big problem with the banks is just a lack of demand, So unless you're Jamie Dimon and you have a big building in Manhattan. So, what can I say?
Beautiful building that is. Yeah.
Yeah, it looks like
Yeah.
the
So,
Chronicles of Riddick.
well, inside looks great. As I told you before the podcast, I had a pleasure visiting. I recommend if you are dealing with JP Morgan and Chase, go visit the building. It's looks just grandiose, right? You walk in,
Mm.
it's a huge stairs. It's very beautiful new building. They just moved people there 3 weeks ago. That's phenomenal.
Well, of course, but remember all around that building on Park Avenue in Madison, the old Bear Stearns building, they're going to be vacating space in those buildings, and someone's going to have to figure out what to do with those buildings. Interesting point. Third Avenue from 42nd Street up into the 50s, they're going to redevelop the whole thing. They're going to turn it into residential, which is what it should be, and
Rent
mixed-use
control?
commercial. Well, no, but those commercial buildings are half empty.
Yeah. Yeah. No. So Mamdani has a big problem.
Yeah, if you chase the business people out of New York, you can't pay for everything.
I agree.
You can't pay for it with retail residential people, no matter how happy they are.
Uh, I think we do have a bigger problem going more socialist in a lot of cities, and I'm worried about U.S. dollar and things like that. Maybe we'll touch on that on the next podcast on how we recover and how we talk about international trade
We're all
and
going to move to
policy.
Uruguay. You come with me.
I will go with you. Yeah, we'll go there, check it out. But Chris, again, I know you have to run. Thanks so much. Everybody, please follow Chris on LinkedIn and read his blog, subscribe to his posts. I think it's a phenomenal read. I am learning quite a bit. I'm learning a lot. So once again, Chris, thanks for your time.
Thank you, Alex.